Hi, and welcome to another video from My Money Calculator. In this video, I'll be showing you how to find out which is a better investment, property or shares. So you can see that I have open here the Money Calculator, which you can download from mymoneycalculator.com.au. And what we're going to do is enter in some details for an investor and two different investment scenarios. One scenario, we're going to invest in property, and another scenario, we're going to invest in shares. Before we begin, you should bear in mind that we're going to be using a number of different assumptions that are aimed at both being realistic and fair to each investment. At the moment, we're on the home page where we can see all the different input sections: investor details, home details, property details, shares, super, and yearly changes. So let's get started entering the investor details. Okay, in this scenario, we're going to want to focus on one investor. So let's leave how many investors are there at 1. Now let's call this investor John Smith. John's 35 years old, has a salary of $100,000 a year, living expenses of $50,000 a year, and a generous savings account of $150,000, and that earns 4.5% interest per annum. Note also some variables down the bottom that we're going to want to put all the surplus cash that John earns into his savings account, and there's going to be an inflation rate of 3%, and the current year is 2011. Okay, let's move on. Let's assume John doesn't have a home, is not considering purchasing one for the moment. He has no existing investment properties, and let's move on to the proposed investment properties. Now let's say John is proposing to purchase one investment property. He's going to purchase this property today. He's going to purchase it outside of super. And for the weekly rental income, I'm going to enter in here $480.7692, which is approximately $481 a week in rent, and you'll see why in a minute. For the annual rental growth rate, let's say this grows at 5%, has a 0% vacancy, and the property value will grow at 5% per annum. Let's say this property has $1,000 in strata fees and $1,500 in council rates every year, as well as $500 in water charges. And it's a fairly new property, and the construction costs on it were $250,000. It was constructed in 2004 and has a fit-out value in it of $30,000. For the property value, let's say John is proposing to purchase a $500,000 property in New South Wales. And we're going to be very generous here and assume no borrowing costs. And as for the deposit, we're going to assume John is going to put down $142,990 of a deposit, which is going to make the total loan amount required $375,000. Now this is a loan to value ratio of approximately 75%. So let's assume this loan is going to be interest only over 30 years, payment frequency monthly, and an interest rate of 8%. So the reason we entered in $481 weekly rental income is because that is going to give us approximately a 5% rental yield on that $500,000 property. So let's move on to the shares details. And we're just going to skip through this section for now. Skip through super, skip through any yearly changes, and go on to the reports page. Now what we want to do is compare John's proposed property purchase with some shares. So we're going to go to the compare scenarios report. Now on the scenario page, we can see a snapshot of John's personal assets and loans, his cash flow, and the tax that he's going to pay each year. Now we're going to label this scenario property. And we're going to click copy to comparison. Now we can see that both of these scenarios are identical. Okay, so now we're ready to enter in some details for our share scenario. So what we're going to do is go back to the proposed properties section by clicking in the left navigation panel. and we're going to change proposed properties for John back to 0. Now let's move on to our shares. So let's assume the same capital growth rate of 5%, the same yield, which will be in dividends of 5%, and let's assume these dividends are fully franked at 100%. There's an 8% interest on a margin loan we're going to set up, and these dividends are not going to be reinvested. So just like with the property, we're going to purchase $500,000 worth of shares, and we're going to borrow $375,000, which could be in the form of a margin loan. Now this is going to make the LVR the same 75%. And we're going to want to buy these shares now, just as we did with the property. Now let's go back to the compare scenarios page. So I'm just going to click compare in the left navigation bar here. And what I'm going to do is label the current scenario shares. Now we can see these two scenarios compared side by side. So let's take a look at this comparison. From the equity comparison graph on the right, we can see that there is much more equity in later years for the share scenario. We can also see from the cash comparison graph that there's a much larger cash surplus for the share scenario in later years. So let's take a more in-depth look at 5 years from today. I'm just going to change the see how many years from now box to 5. Now in the personal assets and loans area, we can see that there is a difference of roughly $40,000 in John's savings account in 5 years from now. This translates to roughly $40,000 more in equity for the share scenario. Taking a look at the cash flow section, we can see John has $8,000 more in cash surplus for the year in the share scenario. So let's take a look at 30 years from now. So in 30 years time, we can really start to see some of the compounding returns factors at work. There is roughly $1.4 million more in equity and $130,000 more surplus cash for the share scenario. And if we look at the difference in tax paid over the 30-year period, there is only a very slight difference, where the investor has paid $8,390 less in tax in the property scenario over the 30-year period. So what is driving these results? Why do the results seem to favor the share scenario? Let's go back and put the property into the mix. And go to our reports page to take a more in-depth look at these investments. Firstly, let's look at how much each investment will be worth. So I'm going to click how much will my investment be worth here. So we can see the proposed property here. Now let's switch to the shares. What you'll notice is that both investments have the exact same asset value over the 30-year period. Both are growing at 5%, and both loan amounts are remaining steady at $375,000. Let's now take a look at the profit or loss on these investments. Let's go back to the reports page and click on what's my profit or loss. If we switch between these two investments again, we can see that both have the same dividends or rent. However, the property has a huge drain on its cash flow from council rates, water rates, and strata fees. The difference means that the shares are cash flow positive years before the property is. This is the major difference between the two investments. So who is the winner? What we can tell about these two scenarios is that given our assumptions about these investments and John's circumstances, it would appear that shares are a better investment than property. The biggest assumption here though is that shares and property will grow at the same rate. It is generally the case that share prices are more volatile than property prices in the real world. This also means that lenders will generally lend more money and at a lower interest rate for property than for shares. So in this video, we've seen two fairly basic scenarios that really only demonstrate a fraction of what the money calculator is capable of. There are many more reports available, and you also have the ability to construct a vast range of different scenarios that can help you better understand the impact of undertaking different investment options. In this example, we could have added many more details, including a home with a mortgage, super or a self-managed super fund, including borrowing to buy property or shares within super, up to 10 investment properties, as well as the ability to change details like interest rates, salaries, bonuses, and one-off expenses like a holiday in any year that we want to. And we could have added another investor. Remember, the money calculator can be used by all Australians, from everyday individuals to experienced investors. So whether you're just starting out or whether you're an industry pro, you can take advantage of this powerful tool, which you can download only from mymoneycalculator.com.au. And as always, thanks for watching.